Game over, Tesla versus JP Morgan. Okay, today's subject is a nice one. If you haven't heard, JP Morgan is suing Tesla for $162 million, saying that the business failed to make a necessary payment after Elon Musk's statement in 2018 that he was taking the company private. According to the court complaint, Tesla warrants issued to JP Morgan compelled the bank to make modifications after Musk tweeted that he had financing secured to buy Tesla for $420 per share. When Tesla subsequently declared that the deal would be scrapped, the value of the warrants altered again, and JP Morgan was forced to make another adjustment position. The case is on a Tesla convertible bond that was issued in 2014. If you're unfamiliar with convertible bonds, they're a sort of bond that the holder may exchange for shares of the issuing company's common stock or the cash equivalent value at a set price. They usually have a low coupon or one that is lower than other comparable debt, but the opportunity to convert the bond into equity adds value. The difference between a warrant and a call option is that when a warrant is exercised, the company issues new equity to provide to the warrant holder, but when a call option is executed, the business issues new equity to deliver to the warrant holder. A simple way to think about it is that when you profit from a call option, the profit comes from the trader who sold you the option. With a warrant, the person on the other side of the deal is the firm whose stocks the derivative is based on. The more money you earn, the more money that company loses, and the stock they have to give to you has its price knocked down by the loss they've suffered. As a result, warrants are valued a little less than call options. Let's have a look at the convertible bond in question now that we know what they are and that they include a warrant. Tesla issued $1.38 billion in 7-year convertible bonds with a 1.25% yield and a conversion price of $359.87 in 2014. These prices were all before the 5-1 stock spill had occurred since then. So just divide them by 5 to get today's pricing. The stock was selling at roughly $250 at the time, so the warrants would have to increase by around 44% to be in the money. Typically, firms create convertible bonds because they wish to issue convertible bonds or borrow money, but they don't like the high interest rate amount loan, so they convert the bond to receive a lower interest rate. They typically attempt to make the conversion price as high as possible, but the issue is that the higher the conversion price goes, the less the warrant is worth and the greater the interest rate you'll have to pay. But perhaps more crucially, if the conversion price is too high, there comes a point when convertible bond investors lose interest in the bond entirely. Tesla got around this by issuing the convertible bond and then buying an option from the banks that were identical to the embedded option in terms of strike price and expiry date, thereby hedging the warrants. You may as well not have issued a convertible bond at this point, right? As a result, they sold a second warrant to the banks with a higher strike price. This combination works because bond investors received the sort of convertible bond they wanted with a low enough strike price, while Tesla was able to raise cash by selling a structure that gave them the exposure of a convertible bond with a considerably higher strike price, the strike price they wanted. The bank that handled the deal now has a call spread on its hands. They are short the low strike call option, which they sold to Tesla, and long a higher strike warrant, which they acquired from Tesla. In this situation, the banks were short a 7-year option with a strike price of $359.87 and long a 7-year warrant with a strike price of $560.64 on 3.8 million shares. Once again, all of these prices are pre-split prices. Tesla would have had to pay the banks for the spread, and the banks would have been exposed to the Tesla stock price risk. The banks will, of course, mitigate this risk by delta hedging their stock price exposure, leaving them vulnerable to Tesla stock price volatility or standard deviation. Options and warrants become more costly as a stock's volatility rises. Through the warrant in question, the banks were long volatility, which indicates that the more the stock price bounces about, the more money they gain from their hedging activities. The largest danger is if Tesla's stock becomes less volatile throughout the course of the warrant, and their hedging fails to cover the cost of the option. Some of this is a little more complicated than others. Okay, so Tesla stocks were and continue to be volatile, making the warrants that the bank purchased from Tesla prohibitively costly. That's good as long as the stock remains volatile. However, something may happen to destroy the stock's volatility, which is an apparent danger from a bank standpoint. A merger announcement is one item that may make a volatile stock less volatile, since once a deal is made that a stock will be bought out at a defined price, the stock comes near to that price and then progressively drifts to that price with minimal volatility until the day the transaction closes. If instead of stock, a small car business like Toyota opted to purchase a huge vehicle firm like Tesla, trading Toyota shares for Tesla shares, the volatility would be much reduced. The warrants in issue were over-the-counter, and the options were executed under an ISDA agreement, which is conventional paperwork in the realm of OTC derivatives. The agreement considers obvious risks, such as mergers and acquisitions. In the event of a foreseen corporate action, such as an acquisition, it is common to include an adjustment provision. The clause gives the bank a lot of leeway in adjusting the parameters of the warrant in order to maintain its value the same. The bank can make such adjustments to the exercise, settlement, payment, or any other terms of the warrant as it determines appropriate to account for the economic effect of the announcement of a merger on the warrant, including adjustments to account for changes in volatility, expected dividends, stock loan rate, or liquidity. So, if a bank owns $100 million in warrants and the company's CEO announces the stock is being taken private the following day, the bank is entitled to decrease the striking price of the warrant until it is worth $100 million again. So, returning to Tesla, since that's what we're talking about here, and many of you have probably already said in the comments, but Patrick, Tesla was never purchased. However, many of you may recall that in 2018, Tesla's techno king and meme lord were crowned. Elon Musk stated on his Twitter account that he would be taking Tesla private for $420 per share. Is this something that should have been handled seriously? Tesla classified Elon Musk's personal Twitter account as a source of relevant public information about the firm in a Form 8K filed with the SEC in November 2013, and then met with investors to evaluate it. Furthermore, Tesla's CFO, communications director, and general counsel produced an email outlining the company's intention to go private, which was released on Elon Musk's Twitter feed and Tesla's blog, which Tesla had also designated as a source of material public information about the company. On a conference call with stock analysts, Elon Musk said the offer to take Tesla private was as solid as it gets. Elon Musk, Tesla's CEO and chairman, spent 3 weeks in 2018 lying that he was taking the company private for $420 per share. Elon Musk, like many on Reddit, thinks the numbers 420 and 69 amusing, but derivatives traders and attorneys do not. As seen by this lawsuit, JP Morgan lowered the strike on the warrants, down from $560.64 to $424.66 when Elon announced his agreement in 2018. Using a warrant pricing methodology that compensated for the lower expected volatility associated with this deal. After Tesla confirmed that Musk was kidding a few weeks later, JP Morgan readjusted the warrant. According to the lawsuit, JP Morgan concluded that, as a result of the August announcement, average implied volatility increased by 5.74 points or 14.3%, and that increasing the strike price to $484.35 was the appropriate adjustment to maintain the same pre-announcement fair value for the 2021 warrants. This is a lower strike price than the warrants began with, and this is the source of contention. JP Morgan informed Tesla of each modification as it was made in accordance with the agreement and supplied paperwork detailing the computations. 6 months later, Tesla responded, claiming that the adjustments were unreasonably swift and represented an opportunistic attempt to take advantage of volatility in Tesla's stock. In fact, that is the job description of a derivative trader. If you are ever interviewing for a job like this, you might include it on your CV that you are unreasonably swift and opportunistic. That'll be a big hit. According to the lawsuit, Tesla's later letter did not dispute that the announcement events had occurred, nor did it question any of the specific calculations or supporting materials JP Morgan had provided 6 months earlier, nor did it provide any evidence to support its assertion that JP Morgan's methodology was unreasonable. Regardless, the warrants expired in June or July of this year. They were in the black regardless of the strike price, but JP Morgan believes that they are entitled $162 million, more than Tesla has paid them, based on strike price revisions that occurred in 2018. Tesla says that none of the other 3 warrant dealers made comparable revisions. JP Morgan was one of 4 banks that functioned as Tesla's counterparty on the warrants transactions for this convertible bond issue. A fact, the other bank's investments were far smaller than JP Morgan's, and they may have written off the modifications to keep a huge client happy. The other 3 banks may expect to earn more money from Tesla's continuing operations than was written down. From JP Morgan's standpoint, pursuing the $162 million may make more sense, given they are unlikely to receive that much money from Tesla in future corporate finance deals. Because I'm not a legal expert, I'll let you decide who should win in the comments area. The key question in this case is whether it was appropriate to take Elon's tweets seriously. The estimate does not seem to be disputed by Tesla. It's also worth noting that during the life of the warrants, the stock turned out to be more volatile than projected, rather than less volatile. Some of this might be because having a CEO who pretends to perform transactions at prices he thinks is amusing causes the stock price to jump around more than having a more serious techno king talking about business initiatives. Thank you for taking the time to watch our video. You may leave your comments in the section below. We will continue to add more films to our library. As a result, your subscription and likes will motivate us to make new videos. We'll meet up again. Goodbye, gentlemen.